Hi, this is Doc Severson for the Theo Night Report for Tuesday, January 17th. I'm going to start out with the dollar index here because this is going to be Exhibit A of what we're going to expect from Trumponomics from this point forward. Basically, with the interview with the Wall Street Journal over the weekend, Trump said that the dollar index has gotten too high and was going to start causing trade problems. So here we go. The dollar index sells down, okay? So what does that mean from here? Well, I think everybody had kind of, after the election, had thought, well, everything's going to be going higher. We're going to be seeing rates go higher, the dollar will go higher, and everything else will be going higher. And basically, it's going to be a balance versus interest rates against the value for stocks. So this weekend's comments were some of the first challenges that we've seen since the rally began that may put a dent in that whole theory. So when we look at the dollar index coming down, so then let's go over to the 10-year note, which is the TNX, and let's see how this has come in today. Again, coming in a little bit down now, about 2.3% on the 10-year note. And because of this, bonds continue to get a bid here. Bonds continue to catch a little bit of a bid here, although I suspect that this is just going to form another lower high and roll over again. In fact, I think this whole thing will eventually normalize itself. If we go back to the dollar index, this is just going to be more than likely just going to be a temporary thing as the dollar index retests the breakout level at about 100 and probably catches a bid from there. Now, the real loser today was the financials. So if we go over here and look at the XLF, which is the financial ETF, we can see that this chart, which has gone way ahead of itself. And if you think about this, think about how the financials have been pretty much given a black eye over the last several years, not only due to Dodd-Frank, but basically also because of the fact that interest rates have been on the floor, in some cases negative around the world, right? So that's the environment that they're in. When you're only charging 1% interest rate, you can't really make much of a margin. How do you make a profit on 1% profit margin? Now, Wells Fargo had their own solution to that, but as we know, that didn't work out so well. So this is why we had financials just completely blasting off from here, jumping up several percent, just because of the fact that with increased rates, you have more gross margin, more room to be able to create a profit margin in there, which is good for them. So this was a little dent in the story today. However, I don't expect to see this coming all the way back in. Yes, we may retrace some of this move to some extent, but I still think financials are going to be a strong player going forward, especially if the new administration kind of takes the veil of enforcement through Dodd-Frank and kicks it to the curb. With that said, though, we are way overdue for some well-needed volatility with the markets right now. We have gotten way too complacent. If we go over here and look at the volatility futures, we're just going to see them absolutely on the ground right now. So even though today had a little poke back up here, this is really nothing in the greater scheme that we have. Volatility is on the floor right now. We are still in a very complacent world. So this is where we may start to see some fear parking up as we start to pull back just a little bit. Now, most of the major indices just brushed this off today, like the S&P barely moved at all, 0.3%. The only chart that really did move much at all today was the Russell 2000, going about 1.5% to the downside. So this is definitely setting up with perhaps a lower high and starting to drift down. But again, you'll notice that this is not exactly selling off. It's still trading within a range. It's still trading within a range here. So what I'm actually looking for is to see whether or not we can have an opportunity for the Dow Jones. The Dow Jones has gotten way ahead of itself. And I think if we see any kind of a pop to the upside in the next couple of days before the inauguration, I will sell into that move. And the way that I will sell into that move is just simply to take, probably on the diamonds here, to take an in-out spread on the diamonds, give myself maybe a month or so of room and set myself up with just a simple spread where we have one option in the money, one option out of the money. And we should be able to do something like this for about $1 or less. If we look at this, trade this vertical here, buying the 199 and selling the 197 is going to give us about an 89-cent debit. And we're going to be looking for probably a 50 to 60% return on a trade like that. So again, all it has to do is just within the space of the next month or so, just go to the expected move or less, and the expected move is only about 5.7 points. So if we come down here to maybe this area here, 195, 194, this trade is a shoo-in for at least a 50% return. So think of it this way, as I go back to the chart here on the diamonds, if this is a very bullish chart pattern. This is a very typical bullish chart pattern, right? Which we've seen before. We've seen before all the way. You know, this one's very compact, very tight. The tighter the pattern, usually the more bullish the setup is. If this cannot break above here and put Bob Bisani out of his misery so that we hit Dow 20,000, if it cannot do that, if every time the price gets anywhere close to that, supply overwhelms the demand, then the price must come back down here. And it doesn't necessarily have to come all the way back down here and undo the entire rally, but it will more than likely retrace some of it to the point where it does catch a bid, and that would be creating more of what we expect here is a larger consolidation here that may turn into something that looks more like this, more like one of these weekly consolidations that's been up here. One of these. Okay, so just a little bit more volatility to the downside, perhaps at least some complacency coming off the top in terms of the volatility futures. This would normalize the market, allow it to take a breather, and set up the next opportunity. Remember, markets do not just drop from the top like this. So unless we have some kind of exogenous event that comes along, which is also known as a bad risk event. Now that could occur from here, but normally if a market's going to do this on its own, it's going to start to get very, very noisy first before it then starts to fall. Usually most of the selling comes at the end of a move like this, not at the very beginning. Okay, so don't forget, we only have 3 days left this week. It feels like a Monday, but this is actually a Tuesday because of the market holiday yesterday. So 3 days left. We have the inauguration coming up on Friday, right? So lots of volatility in store for the rest of this week, I do think. And then the fun begins next Monday. That's it for tonight's report. Thanks for listening, folks. We'll see you tomorrow.